Bitcoin just showed us two different institutional markets at the same time. One is willing to fund Bitcoin's future. The other is still unwilling to fund its next breakout. Nearly $500 million entered U.S. spot Bitcoin ETFs across 3 sessions. Then, almost all of it left over the next 2. Strategy bought nothing, but at the same time, some of the largest firms in digital assets committed millions of dollars to Bitcoin security and long-term network resilience. Institutional conviction has not disappeared. It has separated across 2 different time horizons, and that split is the entire story this week. Bitcoin finished the week almost exactly where it began, trading near 65,000 after failing to hold an early move above 66,000. That quiet price action hides the real signal. Long-term institutions are treating Bitcoin like infrastructure worth securing, funding, and building around. Short-term, they are treating it like a position that still has to earn additional capital. Bitcoin has exited immediate panic conditions, but it hasn't entered expansion. The market is stable enough to resist a breakdown. Fresh demand remains too inconsistent to force the next leg higher. Bitcoin spent the last 7 days inside a relatively narrow range. Daily closes moved between roughly 64,100 and 66,500, with the week ending almost flat. There was an early attempt to extend higher, but it failed. There was also a late week attempt to force the market lower. That failed too. Neither side established control. This is compression, not trend confirmation. The derivatives market tells a similar story. Realized volatility remains compressed, perpetual funding is mildly positive, and leverage is not showing signs of mania. Now, that lowers the immediate risk of a major long liquidation cascade, but it also means speculative positioning is not providing enough energy to lift the market on its own. Bitcoin is not being driven by excessive leverage right now. The next move will probably require an actual catalyst. That makes the boundaries of this range important. A clean move above the recent highs near 66,500 to 66,700 would begin to improve the structure. A decisive loss of 64,000 region would do the opposite. Now, until one of those levels breaks with meaningful volume, this remains a market waiting for confirmation. The ETF tape tells the clearest story of institutional demand this week. According to public ETF flow data, nearly $500 million entered regulated Bitcoin products across the first 3 sessions. Then, approximately 465 million left over the next 2. The full week finished with only about 34 million in net inflows. Capital is still willing to enter Bitcoin, but it is also willing to leave quickly when macro conditions, portfolio risk, or market sentiment change. There is an important bullet counterpoint. Bitcoin absorbed approximately 465 million of late-week ETF outflows without collapsing beneath the range. The selling was meaningful. It did not produce a breakdown, but nearly $500 million of early-week inflows also failed to produce a sustained breakout. So the ETF picture is balanced in a very specific way. Demand is strong enough to support Bitcoin. It is not yet strong enough to lead Bitcoin. And until that changes, every rally remains vulnerable to another reversal in the daily flow data. According to Strategy's last filing, the company made no new Bitcoin purchases during the week. Its holdings remained unchanged at 843,775 BTC, while its dollar reserve rose to approximately 3.75 billion. That does not signal lost confidence from a company already holding more than 843,000 Bitcoin. It signals that one of the market's most visible marginal buyers is currently prioritizing liquidity management over additional spot absorption. Strategy matters because it has repetitively amplified Bitcoin demand throughout this cycle. But it cannot stand in for the entire institutional market. Its current posture is one piece of the demand picture, not the whole picture. The broader corporate environment also appears more selective. Several digital asset treasury companies and miners have been selling assets, reducing debt, or redirecting capital towards artificial intelligence infrastructure. That does not prove institutional abandonment. It shows that capital discipline has returned. The assumption that every treasury vehicle will buy indefinitely no longer holds. Corporate demand must now be evaluated company by company rather than treated as an automatic structural bid. The balance sheet buy remains important, but it is no longer behaving like an unlimited source of demand. The strongest long-term Bitcoin development this week had very little to do with price. A group including major financial and digital asset firms launched the Bitcoin Security Consortium, committing $15 million over 3 years to research and network security. Galaxy also launched a separate quantum readiness initiative with up to $5 million in grants. That is real institutional conviction. These firms are not funding long-duration security research because they believe Bitcoin is a temporary trade. They are behaving as though Bitcoin is infrastructure that may remain economically important for decades. But strategic commitment and near-term capital deployment are not the same thing. Funding security research does not automatically produce ETF inflows next week. It does not force strategy to buy tomorrow. And it does not guarantee a breakout above resistance. It tells us institutions believe Bitcoin's future is worth protecting. It does not tell us they are ready to pay any price for exposure today. The on-chain picture carries the same balance. The percentage of Bitcoin supply in profit has recovered from the panic conditions seen near the end of June. And based on trailing 30-day on-chain data, miner balances remain positive despite financial stress across parts of the mining industry. Those are constructive signs. Exchange reserve data varies by provider and methodology, but the combined message is fairly clear. We are not seeing a uniform rush of Bitcoin onto exchanges. But we are also not seeing the kind of consistent withdrawal pattern that would confirm an immediate supply squeeze. Holders remain resilient. Available supply is not yet tightening aggressively enough to force expansion. Sentiment is also less defensive. Options traders have reduced near-term downside hedging, while longer-dated protection remains more valuable. That suggests the market is less concerned about an immediate collapse. It does not prove traders expect a breakout. The pattern remains consistent. Less panic, more stability, no decisive expansion. Bitcoin now needs to prove one of two things. Either institutional repair can become sustained demand, or the current stability is only temporary. The first confirmation will come from ETF flows. Another sequence of consistent inflow days above roughly 200 million would suggest institutions are moving beyond tactical exposure and beginning to accumulate with greater conviction. More outflow sessions in the 150 million to 200 million range would strengthen the argument that the recent repair is already losing momentum. This range has held so far, but it can also fail quickly if redemptions persist while price loses support. The second confirmation comes from price. Bitcoin needs to reclaim and hold the recent highs near 66,500 to 66,700. Not touch them, not wick through them, hold them. A breakout supported by spot volume and stronger ETF demand would signal that the market is moving from stabilization into expansion. On the downside, a decisive break below approximately 64,000, especially along ETF redemptions and renewed exchange inflows, would tell us that the recovery was more fragile than it appeared. The third factor is macro policy. The Federal Reserve meeting is the immediate outside catalyst. With volatility compressed and leverage relatively balanced, Bitcoin is especially exposed to whatever repricing follows the decision and press conference. A supportive macro reaction could send capital back towards risk assets and test the top of the range. A more restrictive signal could expose how little organic momentum Bitcoin currently has. Finally, watch strategy. A resumed purchase would restore one of the market's most visible demand narratives. Another week of reserve building would reinforce the view that even Bitcoin's largest corporate holder is currently choosing flexibility over aggression. So, the market is not waiting for one piece of evidence. It is waiting for alignment, ETF demand, price confirmation, corporate buying, on-chain participation, and a macro environment that does not immediately reverse the move. Until those signals begin moving together, Bitcoin remains stable, but unfinished. Now, Bitcoin's price is only one layer of the market. ETF flows, corporate balance sheets, custody, liquidity, regulation, and network security all shape how capital enters and exits the asset. That's exactly the framework I break down in Understanding Crypto, a clear guide for new investors. And I'll make sure and drop a link for you. Institutions are underwriting Bitcoin's future. They are not yet underwriting its next breakout. The next move begins when that changes. So, subscribe to CoinOps for disciplined crypto analysis without the hype. Stay locked.